The QSR space, that has turned out to be a hotter space when you look at the equity markets, the reopening trade. But is this a space that's also going to be hurt by inflation, higher input costs? Will they be growing with the same pace as they were before? That's exactly what we're going to be chatting with Westlife about. And we're getting in the first interview with Westlife after their earnings as well. Amit Jatia, the Vice Chairman of Westlife Development, now joining us live on today's edition of The Market. Let's begin with the big question, Mr. Jatia, which is Mengai. Everything is costing a lot more. So going forward, how do you see inflation taking a bite into your business? Has it already done so? Have you been able to increase prices, or are you looking at other things which may not be really possible given the global quality control of McDonald's, smaller French fries, smaller burgers?
Well, firstly, let me tell you, we don't do smaller French fries and smaller burgers. That is not the right way, in our opinion, to tackle inflation.
Our quality control doesn't allow you.
Sorry? In fact, what we've done is fundamentally sound, in our opinion. We firstly have created backward linkages all the way to the farms. And because we are working directly with farmers without any middlemen, I think we've always been pretty prudent in the way we manage inflation for our customers. We believe that when, with 326 McDonald's across West and South and over 400 million consumers using us, we believe that we have to use our supply chain to give them consistency in pricing. So typically, even whatever the inflation might have been in the past, typically our price increases have been 2 to 3%. This year, I must admit, headwinds are very strong, but yet, we will stay within the 4 to 5% price increase for the consumer. While in many commodities like edible oil, even in chicken, etc., the pressure is very high. We hope that with other initiatives on utilities and other line items, we hope to keep our consumers, we hope to keep pricing consistent for our consumers.
Okay, so you're hoping to keep the pricing consistent for your consumers. But what's also very interesting is despite Mengai, despite input costs going up, Westlife was able to increase its margins. Is that going to be possible going forward? And how did this happen? Is it because of, on the back of higher volumes or just more efficiencies, or, the higher priced gourmet burgers?
Sure. I mean, our philosophy is that in any business to succeed, you have to take cost out of the system every single year. So actually, it's a bit of both. Obviously, incremental volumes are helping us. I've always maintained that operating leverage is a big lever for us to get our margins higher. So essentially, with higher volumes, for example, no incremental capex, but per store, the revenue goes up. And therefore, the flow through to the bottom line is pretty nice. So I would say operating leverage is one big thing that has helped us. The other is, of course, cost control. So, for example, utilities, better productivity with our people, all of that has helped us sort of grow margins by 200 basis points.
Morning, Mr. Jatia. Nikunj Dalmia also joining in. Always good to talk to you. Is the consumer back? Is the consumer feeling happy? Is the consumer enjoying that happy meal once again?
Absolutely. I must say that, if you think about it, if you look at the last 2 quarters, consistently our sales have been strong. And in both quarters, there was a lot of disruption. In the previous quarter, pretty much October was non-existent and half of December. Yet we had the best sales ever at almost 500 crores. And in this quarter, January was non-existent. And yet in the 2.5 months that we got, 455 crores in sales, one of the best quarters ever for quarter 4. So consumers are back. Consumers are looking for, brands with safety, as I mentioned before. And I think we provide that brand trust along with all the other things we've done around menu, omni-channel, and all of that. So consumers are back. That there is no doubt.
While we can look at your SSG sale, the most important benchmark which we look at to judge a food company, do you think we should take this with a pinch of salt, because this also would include some stores which are shut same time last year, some new stores which in a sense have been incorporated? What is the right way of looking at your SSG sale?
Our SSG is always consistently measured and that measure is given every time in all our releases. So essentially, this does not include stores that were closed or new stores, obviously, because it's same store sales growth. And therefore, this is a true measure. And I have always maintained that, omni-channel alone will give us about 10% or 12% incremental sales. In fact, last year, same quarter, that is January, February, March of 21, was quite phenomenal because, COVID at that time was behind us and all the impact that we saw was from April 2021. So I must say that going against that good quarter, especially with January being impacted, I think all I can say is I must thank my consumers for coming back to us and helping us with delivering good sales.
What you've reported, how much is that is pure price hike and how much of that is volume?
Sure. So while we don't share breakup, but last year we barely took any price hikes. Or in the entire year, it was about 2%. So essentially, it's definitely not price hike. Like I mentioned to you, as the in-store business started coming back, the delivery business also grew. So, that alone added about 10 to 12% in sales. Secondly, I've been talking about, our chicken strategy, leadership in particularly South India. And that is beginning to take shape because the product is very, very well accepted. It's a differentiated product over, what is available in the marketplace. And we are seeing significant growth coming out of our southern stores as a result of the chicken. And lastly, gourmet burgers have connected very well with the consumer. Today, whenever I talk to anybody, they mention gourmet burgers. That itself for me is a nice qualitative check that yes, it is getting traction in the marketplace.
Let me rephrase phrase my next question in two parts. Part number one, I'm going to take a leap from your answer that the delivery market or the delivery business for you is growing in double digit. Our understanding is that is a high margin business. That is where the margins broadly are higher, right? You save on air conditioning, you save on other factors. That's what our understanding is. Is it true?
No, it's not true. It's not true.
Okay.
In fact, delivery typically is slightly lower margin than in-store.
Okay.
But over the years, we've worked very hard to get that business model right. So, we are quite all right, but delivery business is slightly less margin than the in-store business.
Next question is, as you move up the value chain, whether it is the gourmet burger which you spoke about or the new categories which you've launched, how would you like to split your portfolio into premium, higher margin category and basic category? The basic category is burger and a fry plus a Coke. That's the basic, right? But when you start throwing in a cheese or a gourmet burger or maybe a different kind of a bread, you move into the premium pricing. How is that split changing? Because that's the margin expansion you're working on, I would imagine.
Absolutely. So we have a slightly different way of looking at this whole thing. And for that, let me share with you that there is a construct of the informal eating out market. In the construct, snacking is a pretty big occasion, but meal consumption is the biggest occasion in eating out. Along with that, there's breakfast, there's late night, and so on. Essentially, we are leaders in the snacking segment, without a doubt, and products like aloo tikki, coffee, etc., lend themselves beautifully to that particular segment of eating out. When it comes to meals, we were under-leveraged, and meal segment is the largest segment in IEO. And very selectively, the whole purpose, it is a strategic thought process. It's not just about premiumization of the brand. If you look at gourmet burgers, they are filling burgers, they are indulgent burgers, and that lends itself beautifully towards a meal segment. And therefore, both fried chicken along with gourmet is addressing that segment. I can, of course, later on share that chart with you, and it's also uploaded as a part of our investor presentation. But the whole idea is to gear ourselves larger towards the meal segment and capture that part of the business where we were under leveraged. So that's the strategy behind it. I feel there is tremendous room for growth. Even if you look at the global McDonald's menu, we are across the entire value chain. There is, for example, the dollar menu in the past. And of course, then we have the most premium burgers available in the global McDonald's as well. And in India, we are slowly building that platform out because here it was first about introducing burgers to the consumer. And now it's slowly getting towards indulgence. So I hope you get the two dimensions. It is about snacking occasion, meal occasion, about breakfast and about after dinner day parts, and what are the right products that suit those day parts. And of course, the second dimension is going through the value ladder where consumers want indulgence and therefore the gourmet burgers and the fried chicken.
Amit, hi Aisha. I just have one question. We've been talking about inflation and more inflation. So pricing aside, I want to know whether you're going to get into shrinkflation or not. Is the burger size and the quantum of fries going to remain the same? Or are you going to cut corners there?
No, you can be rest assured that at McDonald's, we don't cut corners in that sphere. We rather do it the right way because consumers are long term and we don't want to get into the cutting of sizes and all that. We've never done it and we don't intend to do that. In fact, if you think about it, instead of cutting size, we've introduced gourmet burgers that are much larger than whatever you ever get at McDonald's. So you cannot expect that from us for sure.
So if the inflation turns, which it will, I mean, it's this quarter or next quarter, inflation has to turn, prices have to come down. Can I say that's the time when you are likely to be enjoying benefits of drop in raw material prices and uptick which you've taken in pricing, or you will bring the product prices down?
No, see, for us, it's not about individual product pricing. Firstly, what I've seen is what goes up never comes down. Okay, so, we might think that when inflation comes down, prices will come down. I have not seen it in my 25 years, especially as part of the consumer McDonald's business. So raw material is here to stay, but it's beyond that. We look at pricing in totality. We do value meals. The whole idea is there are different types of occasions for eating, and there is an occasion where people want to come and celebrate, and at that time pricing is less relevant. And there's a certain product categories that they use at that time. I mean, another example is you look at our coffee. We believe that we have pretty much the best coffee in town, and if you look at a cappuccino price at McDonald's, right? I mean, it's 99 to 110 rupees, and our competition many times is double that. So I feel that we already provide value, and therefore consumers are willing to come and consume at McDonald's. So we provide value irrespective. Even when inflation was not there, our cappuccino was 99 rupees. So that's how we think about it, basically.
Right. Okay, Amit, great speaking with you as always, and we'll chat again soon.
Thank you. Thank you.